Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
Welcome back to Learn for Finance. Just 10 weeks online. And your feedback has been overwhelming. Our first individual stock analysis has garnered hundreds of views. A huge thank you to all our early adopters. The 30-minute videos. Respect.
That's exactly why there's an early adopters special today. We were only supposed to analyze the MONY Group, but many of you already hold AI giants like NVIDIA, Amazon, or Meta in your portfolios. We'll cover that.
Does that mean from today we will additionally deliver a giant AI per episode, but compact?
Exactly. For the AI titles, we only do Step 2, L4F price GPS, and Step 3, Superinvestors check. Step 1, the comprehensive fundamental analysis. We skip if the valuation is not in the buying zone anyway. This way, you get maximum benefit without any ballast.
And today?
The full double menu, first NVIDIA in short format. The purchase zones are currently rather unrealistic, but that's exactly why the view of the price GPS and the Superinvestors split is so exciting. Afterwards, there's the MONY Group with Step 1 complete. So overview, time series, deep dive, and cash flow.
Perfect. First, a depot favorite for the reality check, then pure substance. Let's go. Everyone is talking about NVIDIA. How does it look in terms of valuation? What does our price GPS say?
Facts first. Current price around 174. 12-month range $63 to 184. Wild ride. EPS series 0.18 2021, 2.97 2025 analyst estimate, and 8.80 2030 analyst estimate. Sounds huge, but now it gets exciting.
We are not only looking at growth, but also at valuation. What do the price zones look like?
Historical KGV corridors of recent years. Low 20, high 35. The forecasts, 2025 EPS 297 after 121 in 2024, plus 145%. 2030 EPS estimate 880 plus 196%. That's not far-fetched, but ambitious, due to the massive AI capex boom. If profitability falters and the economy stalls, investments will be temporarily scaled back. A parallel to 2000, the internet booms. Then the question, do we really need this? We know the rest. Follow up for the valuation. If the growth forecasts are too high, the old PE levels are not sustainable. Therefore, I choose conservatively 2030 EPS 5.88 instead of 880. I leave the PE range 20 to 35 unchanged. Zone calculation, conservative. Max target 2030 5.88 times 35 equals $205.97. Lowest risk, stagnation, 2.97 times 20 equals $59.40. This results in buy zone $59 to $97, hold zone $97 to $157, sell zone $157 to $205. At $174, NVIDIA is clearly in the selling area.
That doesn't look good for newcomers, or are you too pessimistic?
I am deliberately conservative, not because the company is bad, but because valuation plus cyclicality plus capex boom together quickly create an expectation cluster risk. If the growth story slips, the multiple drops first, then the EPS.
Translated, dream company does not mean dream price, especially not at 174. And now the favorite chapter of many of you, what would the legends do?
We go through it as always in style groups, value, quality, growth, momentum, contrarian, macro, and then draw the synthesis. Let's start with value, quality. Warren Buffett, quality and fair price, quality top, price too high, avoid. Benjamin Graham, margin of safety, no margin of safety, avoid. Joel Greenblatt, Q plus P, ROIC versus earnings yield, ROIC excellent, earnings yield poor, avoid. Charlie Munger, quality first, phenomenal company, entry price demanding, hold, buy, only after correction. John Neff, low PE growth, PE too high, avoid. David Dodd, intrinsic value, insufficient intrinsic safety margin, avoid. Seth Klarman, margin of safety, expectation risk, too much perfection priced in, avoid. Interim conclusion, value, quality. Mostly avoid, hold to the maximum with Munger thinking. Top company, but not at any price. Now comes growth. Peter Lynch, GARP, growth at a fair price. Growth, yes, fair price, questionable, hold. Philip Fisher, innovation DNA and management quality. World-class innovator, buy, hold. T. Rowe, Price Jr., secular growth, decade trend intact, buy. William O'Neill, can slim, explosive EPS sales growth, plus RS, prime example, buy. Interim conclusion on growth, majority pro, buy, hold, with Lynch as price guardian. Now on momentum and trend. Mark Minervini, SCPA, trend and base breakouts. Buy as long as the setup, base, RS volume remains intact. Nicholas Darvas, box theory. Box break, ish new high. Buy as long as the box is not broken. Interim conclusion on momentum. Pro, but strictly setup disciplined. No blind. Holding without trend confirmation. Now to contrarian macro. Howard Marks, second level thinking. Is perfection priced in? Expectation risk high, avoid weight. George Soros, reflexivity, ride the trend, but be ready to turn at any time. Hold trade tactically. Interim conclusion, contrarian macro, skepticism due to expectation overhang, tactical approaches instead of buy and hold.
In short, growth and momentum are mostly pro, value, and contrarian rather contra.
Exactly. It essentially means trend players find their setup, as long as the trend remains intact. Value quality investors wait for price relief versus multiple normalization. Contrarians stay tactical because expectations are high and reversal risks are real.
Also, Traumfirma yes, purchase price no, correctly summarized?
Yes. Price GPS. At 174, NVIDIA is clearly in the sales zone, red light. Superinvestor split, growth and momentum, mostly pro, value and contrarian, rather contra. Consequence, trend players can play setups tactically. Value GARP wait for multiple normalization. Contrarians remain flexible and strict with stops.
It means poster on the wall, yes, press the buy button, later.
Exactly. Fan of the company, not a fan of the price.
Now let's make a clear reset. Down from the AI hype, over to substance.
MONY Group, Step 1, complete, overview, time series, deep dive, cash flow and working capital, score and SWOT. Fewer spotlights, more cash quality.
Let's start with the current annual report 2024. How is the quality of the completion?
Brief and concise. The 10 checkpoints with score. A. Testdauer, deadline 31.12.2024, auditor signature 3.3.2025, 62 days, 4 to 5, close to ideal. B. Confirmation note. Deloitte LLP, unqualified, KM well explained, 5 to 5. C. Board statements, clear and consistent, record revenue, EBITDA plus, Super Safe Club, challenges identified, 5-5. D. Revenue, 439.2 million plus 2%. Solid, driven by insurance, money, travel weaker, 4 to 5. E. Quality of results. Adjusted EBITDA, 141.8 million, plus 7%, margin 32%, profit after tax, 80.2 million, plus 11%, 4 and 5. F. Balance sheet, equity, change from net debt 19.8 million 2023 to net cash 8.4 million 2024, 5 to 5. G. Liquidity, financing, operating cash flow 115.6 million plus 113%, very strong, 5 to 5. H. Capex investments, asset light, R&D focused, strong FCF, 4 to 5. I. Dividend 12.5 pence, Palos 3%, buyback up to 30 million, 5 to 5. J. Transparency, APM explanations, clear segments, glossary 5 to 5. Total 4650, 92%. Conclusion, financially healthy, strong cash generating, top transparency. Small dent, revenue only plus 2%, and high insurance dependency.
How robust is MONY over 5 years?
The trends at a glance, each with a score per category. Revenue, 2020, 344 million to 2024, 439 million plus 2% compared to the previous year. Volatile, dependent on interest or travel, 3 took 5. Margins, low point 30%, 2021, 32%, 2024, steady recovery, 4 took 5. EBITDA EBIT trend, clearly higher, cost control in place, 4 took 5. Capital structure, net debt, net cash, $8.4 million, 2024, equity ratio robust, 4.5. Working capital, structurally negative, very efficient, CF drivers, 5 to 5. CAPEX, depreciation, moderate, IFRS compliant, no excesses, 4 to 5. FCF, distribution, FCF consistently covers dividends, 5 to 5. Goodwill and M&A. Quidco integrated, latent impairment risk remains, 4 to 5. Segment transparency, consistent, clear, 5 to 5. Management quality, continuity, strong crisis management, 5 to 5.
Resilience, yes, but the sales dynamics are not the strongest, correct?
Total score, 43 to 50, 86%. Resilience demonstrated, balance sheet strengthened, top cash flow. Downside, moderate sales dynamics and insurance lumps.
Now we're putting on the gloves. Forensic mode. Any red flags, Axel?
We go through the notes point by point, with a score for each subject area. Activated development costs, appropriate methodology consistent, 4 or 5. Provisions and legal risks, unobtrusive, plausibly explained, 5.5. Deferred taxes, transparently derived, no anomalies, 5.5. Pensions, only DC, defined contribution, no DB risk, 5.5. Financial instruments, yachts hedging, insignificant, no complex structures, 4 to 5. Contingent liabilities, none material, 5 to 5. Valuation methods and impairment test, consistent, goodwill test clean, assumptions understandable, 4 to 5. Related parties and remuneration, market standard disclosed, 5 to 5. Risk report and ESG, solid clear allocation of material risks, 4 to 5. Score, 45-50, 90%. Clean balance sheet and notes. The only ongoing issue remains the goodwill block, thoroughly tested but based on model assumptions, so keep an eye on it.
In plain English, no hidden mines in the footnotes, cash quality remains credible, and we regularly review the goodwill. Cash is king. Does money really deliver cash?
Yes, and quite consistently. Operating cash flow exceeds profit every year, high cash quality. Free cash flow is strong and comfortably covers the dividend. 2021 saw negative investment cash flow due to the Quidco acquisition, now fully digested. Working capital is structurally negative, acting like interest-free financing and providing a clear liquidity advantage. Overall, excellent liquidity.
Structural negative means money receives money early and pays out later. This results in more cash flowing through the books without the need for debt. That's exactly what we want to see.
Score 20, 20, 100%, practically unbeatable when it comes to cash flow and working capital.
Before we go to the market overview, what is the overall score for Step 1?
The invoice is clear. Overview 2024, 46 out of 50. Timeline 2020, 2024, 43 out of 50. Deep dive notes 45 out of 50. Cash flow and working capital 20 out of 20. Total 154 out of 170, 90.6%, very good.
And the SWOT? Once compact, strengths, weaknesses, opportunities, risks.
Strengths. Cash machine, 30% EBITDA margin, net cash, efficient working capital, experienced management. Weaknesses, moderate growth, goodwill risk, insurance lumps. Opportunities, data upside, super save club, shareholder returns, dividends buybacks, bolt-on M&A. Risks, Google SEO dependency, FCA regulation, macro cycle, competition.
It means defensive quality with income character and very clean balance sheet. But the growth levers and the SEO regulatory dependence remain the key issues we are monitoring.
Exactly. With that, We have completed step 1. The foundation is in place. Next, market picture and then price GPS. Step 2, plus Superinvestors. Step 3, for MONY.
Before we proceed with the assessment, what does the city say? Price, consensus, dividend?
Exchange rate 1.99, consensus target 2.60, high 3.0, low 2.04, plus 40% upside, dividend yield 6.2%.
First half year 2025. Revenue, $225.3 million, up 1%. Adjusted EBITDA, $75.1 million, are up 2%. Adjusted EPS, 9.3 pence, up 4%. Segments, insurance minus 2%, auto minus 9%, home plus 4%, money plus 4%, home services plus 29%, cashback minus 9%. Balance sheet as of 30 June 2025. Net debt $18.4 million through buybacks. It means income case with decent returns and solid first half stability, but top line rather moderate. The segment levers need to deliver.
Exactly. And now we place the price GPS template over it. Step 2, course zones, CAGR, reward risk. Then step 3 with the Superinvestors.
After the foundation, the key question, how attractive is money currently valued?
Exciting point. Current rate 1.99. Less known, but interesting.
No, the rhyming is already working.
It's surprising that you notice this. Let's take a look at the table. EPS growth has been rather modest over the past 5 years. Instead, there was compensation through the dividend yield. EPS 2024, 0.15. EPS 2029, analyst estimate. 0.20. EPS growth, 6.1% PA, and current dividend yield approx. 6.2%. This results in a 5-year average. High PE 19.75, low PE 13.33, average dividend 7.3%. But with the 6.1% EPS growth, the old PE levels are too high. Therefore, conservative, high PE 15, low PE 8. Maximum target price 2029, analysts EPS estimate. 0.20 times 15 equals 2.878. Lowest risk, stagnation. 0.17 times 8 equals 1.66. Purchase zone, 136 to 1.71. Hold zone, 1.71 to 242. Selling zone, 242 to 278. Currently, 1.99 or below the hold zone.
And the chance risk profile?
Annual return excluding dividend, 6.9% PA. Annual return including dividend, 13.2% PA. Reward risk, 1.35. The 6.2% dividend yield acts as an inbuilt buffer.
Also value charm, but rather defensive, correct?
Yes, with restrictions. Return profile, without dividend under value benchmark, with dividend up to approximately 13.2% PA, still not a top value outlier. Zone valuation, price in hold zone, defensive value opportunity, no growth profile. Risk reward, 1.25 is too low for a true value highlight. Without dividend, it would be unattractive. Conclusion, defensive dividend stock with a strong balance sheet. Not a price surprise machine, but reliable payouts.
Uninteresting for growth momentum traders, solid for dividend investors?
Exactly, defensively solid, not a growth case. My approach, initial position okay, or wait until the buying zone. I hold MONY myself as a supplement. Maximum 0.5 to 1.0% of the portfolio weight, currently about 3% in the red. For me, the approximately 6.2% dividend is sufficient. The kicker, if earnings growth sustainably increases again, the old PE averages could return. Then around £4 could be possible.
Sounds like dividend anchor with optional re-rating. But what do the legends say?
Now step 3, the Superinvestors check for MONY, from Buffett to Soros.
And now the view through the 15 legends. Who would like money and who wouldn't?
We proceed in style groups, with a brief why and judgment. Let's go. Warren Buffett, quality and fair price. Understandable model, insurance, credit, energy comparison. Moderate moat, solid management, attractive valuation, high dividend. Judgment, buy, solid value stock, not a core miracle company. Benjamin Graham, margin of safety. Strong financial position, stable profits, regular dividend, moderate PE and PB ratios, margin of safety present, conservative profile. Judgment, buy, conservative value case. Joel Greenblatt, quality plus price. Stable capital returns, attractive price, fits into the Q plus P grid. Decision, buy. Charlie Munger, quality first, solid company, honest management, reasonable price, dividend strong quality component. Decision, buy. David Dodd, intrinsic value focus on intrinsic value, protection margin, more pro value at MONY, judgment, buy. John Neff, low PE with decent dividend, low PE, income character, classic Neff candidate, judgment, buy. Seth Klarman, margin of safety, balance sheet and dividend provide buffer, expectations moderate. Judgment, buy, more defensive capital preservation. Now growth, Peter Lynch, GARP, simple story, stalwart, but too little growth, no 10-bagger. Judgment, avoid, maximum dividend yield as a holding component. Philip Fisher, innovative long-term player, no major innovation scaling story. Judgment, avoid. T. Rowe Price Jr., secular growth seeks long-term growth leaders. Money is income value, not a secular grower. Judgment, avoid. William O'Neill, can slim, quarterly annual growth weak, no N, new products, no RS momentum. Judgment, avoid. Now momentum and trend. Mark Minervini, SEPA trend, no high-speed setup, dividend stock instead of trend rocket. Judgment, avoid. Nicholas Darvas, box breakouts, no box break, new high setup. Judgment, avoid. Now contrarian and macro. Howard Marks, second level thinking. Low risk, stable balance sheet, dividend buffer, limited opportunities, no structural growth, can be boring but interesting, only defensive. Judgment, hold, capital preservation, no home run. George Soros, reflexivity, boom bust. No reflexivity spiral, no boom bust leverage, too defensive. Judgment, avoid, ignore. So here you see all the investors again at a glance and their assessments according to their criteria. It is clear that MONY Group is viewed very differently by the individual investor groups. It would also be surprising if, for example, the growth hunter investor O'Neill rated the stock as a buy. That's why this compilation is so valuable for the classification.
Value quality sees money as a buy. Growth and momentum suggest avoiding. Contrarian, macro remains defensive, selective.
Exactly. Translated. Dividend value with capital preservation profile. No growth or momentum play. Those seeking income plus defensive stability will find their building block here. Those looking for growth trend, rather not.
Two worlds, one framework. Axel, give us the three-line view. What has stuck with you today?
Firstly, NVIDIA. Price GPS red at around $174, sales zone. Growth and momentum are pro, value and contrarian rather contra. This is tactical, not value appropriate. Secondly, MONY. Strong fundamental basis. Step 1, overall score 90.6%. Price GPS hold zone at around 1.99. Return ex dividend 6.9%. Including dividend 13.2%, RR approximately 1.25, dividend yield approximately 6.2% as a buffer. Value, quality recommend buying, growth arch momentum avoid, contrarians are defensive. Thirdly, NVIDIA only suitable for trading with trend setup and stop, better to keep away, MONY as a dividend component with tranching instead of all in.
What should we pay attention to in the future?
NVIDIA, gross margin path, AI capex versus profitability, order density, hyperscalers. MONY, EPS acceleration, SEO regulation, FCA, segment leverage, home services money, dividend coverage, i.e., whether the distributions are sustainably financed. And while we're on the topic of the future, this video remains around 20 minutes despite the bonus. I'm working on that too.
That's right, Axel. I stand firm. Axel was diligent and may continue.
Very gracious.
Now it's your turn. Which AI giants should we analyze next in the Step 2 and 3 short format? Amazon, Meta, Apple, Alphabet, or Microsoft? And would you like to see a substance-based title like MONY again as a value case in the full Step 1-3 mode?
If you like the double format, like, subscribe, bell, and share it with someone who wants to clearly separate trend and dividend. Capital preservation before gambling. The rest are rules and discipline.
Thanks for being there. Clear analyses, wise decisions. Until the next episode.
A big thank you from me to everyone who has stuck with us so far. It shows me one thing. You are already living our slogan. Learn smart, invest smarter. Your Axel.
Disclaimer: the content on the YouTube channel, Learn for Finance, is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations or forecasts are no guarantee of future results. Important note: investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.